Hello, let's take a look at basics of credit spreads and why we do them and how we do them here at MasterTrader. So basic math here, unrelated to the option table that we're looking at. The idea behind a credit spread is to sell something that's more expensive, buy something that's less expensive, and keep the difference. That's the basics. So what I've got here is we're going to sell something for $2, buy something for $1.50. We get 50 cents, one contract is 100 shares, we get 50 bucks. Okay. Now the spread difference, what's our risk? So let's say that this contract, and it doesn't matter what the contract is, it's the spread difference. So here I'm showing you a $5 spread difference times 100 shares. If it goes to our strike, closer strike, the possible loss is $500. We took in $50, so our maximum loss is $450. Our maximum gain is $50. So the next thought, if you're new to credit spreads, is why the hell would I do something to make 50 bucks and potentially risk $450? It makes absolutely no sense whatsoever. On the surface, agreed. So, but there is volatility and time and the price movement and price patterns that we use as master traders to put the odds in our favor to collect the 50 bucks and not risk the $450. Now there is gap risk. That's the unknown. But let's just stick to why we're doing this. And I've got a few lines here, and I'm using Tesla because it almost always has premium. So here, where prices are at $438, that's called at the money, and the closest strike here on this call option is 480, and you can see the price here. Pretty expensive. There's 5 days to expiration. This will be worthless potentially if it's under that price at the end of the week. So would we sell a credit spread on that? The price is attractive and the price difference, but it's right there. So what we're looking for here as we look at these price patterns is what's the probability of Tesla going up or down in a certain amount of time? Now, one of the things we're going to take into consideration is the stock going up, down, or sideways. As we can see, Tesla is in a downtrend. The probability is that it keeps going down. Well, down to where? And how long might it take to get there? Well, these are unknowns, but looking at the charts, we have to come to an educated decision. Now, initially, we'd look at this and say, well, since it's in a downtrend, the probability is it's not going to go up. Of course, that doesn't mean it can't go up. So, as we're closer to the current price and where resistance is, I marked here $889. So we go here to $889. We go to $900, and we see the price $7.15 by $7.35. Now, you can typically do the midpoint somewhere in between. But what's the probability of it possibly going to $900? Well, any bullish event in the market could push this up to $900. So we're not interested in that. It's just too close. Someone might be attracted to it, thinking if it breaks this low, it might keep going down. Well, it might, but we're looking for as close to a sure thing as we possibly can. So as we go further up, where's the next resistance point? 926. Well, we go to 925, $3.70 by $3.85. That's a decent amount of money for 5 days. Well, what's the probability of it going up there? Well, lower than getting to 900, but still it's not that far away. And so we continue. Well, how about $950, where there's all of this resistance here? Can we go up above that? So we look at the option table, and now we're all the way down to $1.47 by $1.50. Big difference from that 900. Now, but what we're looking for is not necessarily to collect more money. We're looking to collect less money, but closer to a sure thing. So this is the idea. And as we go further away, and with Tesla, a lot of times there's going to be a significant premium because it's a very volatile stock. Now, what if we said, what's the probability of it getting to $1,000 in 5 days? You might say, Greg, that's impossible. It's never going to get there. Well, I wouldn't say impossible, but I'd say it's a pretty damn good probability. And if we go and look at $1,000, and we see now it's only 58 cents by 60 cents. Say, well, that's just not worth it. Okay, let's move on. Some days there is enough premium that far away. That's the unknown. So now if we look at the downside and say, well, since it's in a downtrend, we think that it'll go down. Well, how far down? Will it go to $700 in 5 days? It might. And there are going to be more people thinking that, and they're going to bid up the price of those options because of the downtrend and the fear that it might actually go lower. So we look at $700 and we see it's $1.81 by $1.85. Well, what's the probability of it going under $700? Well, let's look at the premiums. Well, how about $650 in 5 days? 73 by 76. Can we sell that and buy something cheaper? Well, that's $10 wide. So now we know the risk based on our calculations is substantial for what we're going to get. It's always going to be that way with a credit spread. The potential risk is always going to be a heck of a lot more than your potential gain. The premise behind these is there enough premium very far away in a relatively short amount of time that the price pattern supports a bias that it's not going to get there? And that's what we call the factory work. Looking at price patterns on a daily basis. Of course, it brings into what's happening in the broader markets, what's the trend. Sometimes we look at market internals. In other words, what is the probability of a particular instrument going up or down? Where's support? Where's resistance? How far away are the premiums? What are the premiums? How far away? It's all about probabilities and where prices won't go. So the great thing with credit spreads is because they're a non-directional bias per se, is that even if it goes flat, that's fine. Whereas if we're going to short this, and it is a short setup here, that we'd be looking for it to go lower, we only make money if it goes down. With a credit spread, it doesn't have to go down. If it goes down and we're selling a call spread, great. If in a put spread, it's going against us. As long as it doesn't go all the way down here, we get to keep the money at the end of the 5 days. And of course, we can go out more days, and then there's more money involved, but comes into more probabilities and so on. The shorter amount of time, the greater the odds that we'll be able to call the direction or non-direction of prices. Get a trial to the Green Room. You can subscribe to the weekly options letter. Great amount of education there. Everything is explained in the letter. Intraday updates are provided via text messages with charts. Everything's explained. So there's a lot of education about what we're doing, why we're doing it. So check it out. Any questions, email me, Greg at Master Trader or Dan at Master Trader.